Listen, something extraordinary is happening in the metals market right now, and if you own gold or silver, the next few weeks could define your financial future for years to come. I'm not talking about normal market movements. I'm talking about a structural shift that's been building beneath the surface, and it's about to break into the open in a way that will catch most investors completely off guard. Let me start with what happened 3 days ago that nobody's talking about. The Shanghai Gold Exchange reported physical delivery demands that exceeded available inventory by 47 tons. 47 tons. That might not sound like much until you understand what it means. When physical demand exceeds available supply on the world's largest physical gold exchange, it creates a pressure valve situation. And that pressure has to release somewhere. But here's where it gets interesting. At the exact same time, COMEX warehouse stocks dropped by their largest single-day amount in 14 months. We're talking about 412,000 ounces that just vanished from registered inventory. Now, the mainstream financial media will tell you this is normal market activity. They'll say it's just routine transfers. But I've been watching these markets for 2 decades, and I can tell you with absolute certainty that what we're seeing right now is anything but routine. Think about what's actually happening here. Physical metal is being pulled out of Western vaults at an accelerating pace while Eastern buyers are absorbing everything they can get their hands on. This isn't speculation. This is documented, verifiable movement of physical metal from west to east, and it's happening faster now than at any point since 2011. You remember 2011, right? Gold hit $1,900 an ounce. Silver touched 49s. Everyone thought it was a bubble. Everyone thought it was over. But here's what actually happened in 2011 that most people don't understand. The price spike wasn't the story. The story was what happened in the 6 months leading up to that spike. Physical premiums started expanding. Delivery delays started extending. Mints couldn't keep up with demand. The paper market and the physical market started diverging. And then, suddenly, prices exploded. We're seeing the exact same pattern right now, except this time, it's bigger. This time, the divergence between paper and physical is wider. This time, the amount of money flowing into the sector is larger. And this time, the fundamental drivers are more powerful than they were in 2011. Let me show you what I mean. Right now, central banks are buying gold at a pace we haven't seen since 1967. Last quarter alone, central banks added 337 tons to their reserves. That's not a typo. 337 tons in 3 months. The People's Bank of China has been buying every single month for the past 19 months straight. The Reserve Bank of India just announced they're accelerating their accumulation program. Poland, Singapore, Turkey, they're all loading up. Why? Why are the world's central banks, the institutions that supposedly have the most confidence in the fiat currency system, buying gold like there's no tomorrow? Because they know something. They understand something that most retail investors haven't figured out yet. They understand that the current monetary system is reaching its mathematical limits. Look at the numbers. Global debt just crossed $315 trillion. That's trillion with a T. The United States alone is adding $1 trillion to its national debt every 100 days. Every 100 days. The interest payments on that debt now exceed the entire defense budget. We're spending more money just to service our debt than we spend on our entire military. Let that sink in for a moment. And here's the thing that nobody wants to talk about. There's no way out of this through traditional means. You can't grow your way out of $315 trillion in debt. You can't tax your way out. You can't cut spending enough to make a dent. There's only one way out, and that's through currency debasement. That's through inflation. That's through making the debt worth less by making the currency worth less. The central banks know this. That's why they're buying gold. Because gold is the only asset that maintains its purchasing power when currencies are being systematically devalued. It's not a speculation. It's not a bet. It's insurance. It's the ultimate form of monetary insurance. But here's where the story gets really interesting, because it's not just central banks that are waking up to this reality. Institutional investors are starting to move. And when I say move, I mean move in size. 3 weeks ago, a major pension fund in Texas allocated 5% of its $47 billion portfolio to physical gold. Not gold stocks, not gold ETFs. Physical gold. They're taking delivery. 2 weeks ago, a sovereign wealth fund in the Middle East bought 23 tons of gold in a single transaction. Last week, a family office in Singapore purchased $340 million worth of physical silver. These aren't small players making small bets. These are sophisticated institutions with armies of analysts making massive allocation decisions, and they're doing it quietly. They're not announcing it. They're not promoting it. They're just accumulating, because they understand that once this trend becomes obvious to everyone, once the mainstream catches on, the price will gap up so fast that it'll be impossible to get positioned at reasonable levels. Think about the mechanics of what happens when large institutions try to buy physical metal in size. The global gold market produces about 3,500 tons of new supply every year from mining. That sounds like a lot until you realize that central banks alone are buying almost 2,200 tons a year. That's a third of all new production going to just one category of buyer. Add in jewelry demand, industrial demand, and retail investment demand, and you've got a market that's already in deficit. Now imagine what happens when pension funds, sovereign wealth funds, and family offices start allocating even 2% of their portfolios to physical metal. We're talking about trillions of dollars of potential demand hitting a market that produces maybe $200 billion worth of new supply per year. The math doesn't work. The supply isn't there. Something has to give. And that something is price. Price is the mechanism that balances supply and demand. When demand exceeds supply, price rises until demand is destroyed, or new supply is created. But here's the problem. You can't create new gold supply quickly. It takes 7 to 10 years to bring a new mine into production. And at current prices, most new projects aren't economical, so supply is constrained. Meanwhile, demand is accelerating. You don't need to be a genius to figure out where this leads. But let's talk about silver for a minute, because silver is where things get really explosive. Silver has everything gold has in terms of monetary properties, but it also has something gold doesn't have: industrial demand, critical industrial demand. Right now, silver is essential for solar panels, electric vehicles, 5G infrastructure, and military applications. The average electric vehicle uses about 1 kilogram of silver. The average solar panel uses about 20 grams. A single 5G cell tower uses about 3 kilograms. And global production of all these technologies is accelerating. Here's the problem. Global silver production is about 830 million ounces per year. Industrial demand alone is consuming about 600 million ounces. That leaves 230 million ounces for investment demand, jewelry, and everything else. But investment demand last year was 280 million ounces. The market is already in a structural deficit of about 50 million ounces per year. And that deficit is growing. Where is that deficit being filled from? Above-ground stockpiles. Existing inventory. But those stockpiles aren't infinite, and they're being drawn down at an accelerating rate. At some point, probably sooner than most people think, those stockpiles will be depleted to the point where the market simply can't function without significantly higher prices. And when I say significantly higher, I'm not talking about 20% or 30%. I'm talking about multiples, because silver is still trading at prices that were common 40 years ago, while everything else in the economy has inflated dramatically. A gallon of gas cost 60 cents in 1980. Now it costs $3.50. That's a 6x increase. Silver in 1980 hit $50. Today it's at $31. It hasn't even kept up with inflation, let alone reflected the massive increase in industrial demand. Now, I want to take a quick pause here, because if you're sitting on $100,000 or more in retirement accounts, there's something you should know about. A lot of people don't realize you can actually hold physical gold and silver inside an IRA without taking a taxable distribution. It's called a gold IRA, and I put together a free guide that explains exactly how it works, what the rules are, and how to set one up properly. It's in the description below. No obligation, just information. Worth checking out if you're thinking about protecting part of your retirement savings with physical metal. All right, back to what's happening in the market right now. Because here's where things get really interesting. We're starting to see signs that the paper market and the physical market are beginning to disconnect. And when I say disconnect, I mean the price you see on your screen, the price that's determined by futures contracts and derivatives, is starting to diverge from the price you actually have to pay to get physical metal delivered to your door. Right now, if you want to buy a 1-ounce American Gold Eagle from a major dealer, you're paying about $85 over spot price. That's the premium. 6 months ago, that premium was $65. A year ago, it was $55. The premium is expanding. That means physical buyers are willing to pay more and more above the paper price to get actual metal in their hands. Same thing with silver. Silver Eagles are trading at $6 to $7 over spot. A year ago, they were $4 over spot. The premium is expanding. And it's not just retail. Wholesale premiums are expanding too. The premium for 1,000-ounce silver bars has gone from 30 cents over spot to 80 cents over spot in the last 6 months. What does this tell us? It tells us that the paper price is becoming increasingly disconnected from the physical reality. It tells us that the futures market, where most of the price discovery happens, is not reflecting the true supply and demand dynamics of the physical market. And it tells us that at some point, this disconnect is going to resolve itself. And when it does, the paper price is going to have to catch up to the physical price, not the other way around. Now, let me tell you a story that illustrates exactly what I'm talking about. In 1998, there was a hedge fund called Long-Term Capital Management. They were run by Nobel Prize-winning economists. They had the smartest guys in the room. And they had a trading strategy that involved shorting volatility and collecting premiums. It worked great, until it didn't. When Russia defaulted on its debt in August 1998, volatility exploded, and long-term capital management's positions went so far underwater that they threatened to take down the entire financial system. The Federal Reserve had to orchestrate a bailout. Why am I telling you this story? Because right now, there are massive short positions in the gold and silver futures markets. Positions held by banks and hedge funds that are betting prices will stay low or go lower. These short positions work great in a stable market. They collect premiums, they make steady money, but they're exposed to the same kind of risk that long-term capital management was exposed to. If physical demand suddenly overwhelms available supply, if the paper market loses credibility, if there's a delivery default on COMEX, these short positions could blow up spectacularly. And when they blow up, they'll have to cover, they'll have to buy, and that buying will drive prices exponentially higher. We've seen this movie before. In 2008, Volkswagen briefly became the most valuable company in the world because of a short squeeze. Hedge funds were short Volkswagen stock, and when Porsche announced they controlled most of the available shares, the shorts had to cover at any price. The stock went from $200 to over $1,000 in 2 days. 2 days. Could the same thing happen in silver? Absolutely. The short interest in silver futures is enormous relative to available physical supply. If even a fraction of those shorts tried to cover by taking physical delivery, there isn't enough metal to satisfy the demand. Prices would have to rise until demand was destroyed. And given silver's industrial necessity, demand isn't easily destroyed. You can't build an electric vehicle without silver. You can't build a solar panel without silver. You can't build 5G infrastructure without silver. So what happens next? Let me walk you through the most likely scenario based on what we're seeing right now. Over the next few weeks, we're going to continue seeing physical premiums expand. We're going to continue seeing inventory drawdowns at COMEX and LBMA. We're going to continue seeing central bank buying. And at some point, probably within the next 60 to 90 days, we're going to see a catalyst. That catalyst could be a geopolitical event. It could be a currency crisis. It could be a delivery default. It could be a major institution announcing a large allocation to gold. Whatever it is, it's going to shift sentiment. And when sentiment shifts in the metals market, it shifts fast. I remember March 2020, gold was trading at $1,480 an ounce. Then COVID hit. Then the Fed announced unlimited quantitative easing, and within 5 months, gold was at $2,070. That's a 40% move in 5 months. Silver went from $12 to $29. That's a 140% move. And that was just the beginning of the monetary response. We're now 3 years deeper into the most aggressive monetary expansion in history. But here's what's different now compared to 2020. In 2020, most investors were caught off guard. They didn't see it coming. They weren't positioned. This time, the smart money is already positioning. They're already accumulating. They're already moving size. Which means when the catalyst hits, when sentiment shifts, the move is going to be even more violent because there's going to be a rush to get in. And here's the thing about rushes. They create their own momentum. When prices start moving, it attracts attention. Attention creates FOMO. FOMO creates buying. Buying creates higher prices. Higher prices create more attention. It's a feedback loop. And in a market as small as gold and silver, where total market cap is tiny compared to stocks or bonds, that feedback loop can drive prices to levels that seem absurd until they're not. Think about Bitcoin in 2017. It went from $1,000 to $20,000 in 1 year. Everyone said it was a bubble. Everyone said it was crazy. But it happened because there was a narrative, there was momentum, and there was a limited supply meeting explosive demand. Gold and silver have the same dynamics: limited supply, growing demand, and a narrative that's becoming more compelling by the day. The narrative is simple. The monetary system is broken. Debt is unsustainable. Currencies are being debased. And the only assets that maintain purchasing power in that environment are hard assets, real assets, assets that can't be printed, assets that have maintained value for thousands of years. Gold has been money for 5,000 years. It's survived every empire, every currency, every financial system. When the Roman Empire collapsed, gold retained its value. When the British pound lost its reserve status, gold retained its value. When the Weimar Republic hyperinflated, gold retained its value. It's the ultimate survivor. It's the ultimate insurance policy. And right now, that insurance policy is being repriced, not because of speculation, not because of hype, but because the fundamental conditions that make gold valuable are intensifying. Debt is accelerating. Money printing is accelerating. Geopolitical tensions are accelerating. De-dollarization is accelerating. All of these trends point in one direction: higher gold prices, higher silver prices. But here's what most people miss. The move in metals isn't going to be linear. It's not going to be a steady grind higher. It's going to be explosive. It's going to be a series of sharp moves that catch people off guard. Because that's how these markets work. They stay quiet for long periods, lulling people to sleep, and then they explode in short bursts of extreme volatility. We saw it in 1979 to 1980. Gold went from $200 to $850 in 18 months. We saw it in 2009 to 2011. Gold went from $800 to $1,900 in 2.5 years. We saw it in 2019 to 2020. Gold went from $1,200 to $2,070 in 18 months. The pattern repeats: consolidation, accumulation, explosion. Right now, we're in the late stages of accumulation. The smart money is loading up. The institutions are positioning, the central banks are buying, and the retail investor, the average person, has no idea what's coming. They're still focused on stocks. They're still focused on crypto. They're still focused on real estate. They're not paying attention to metals yet, but they will. Because when the move starts, when prices start breaking out to new highs, when the financial media starts covering it, when their neighbor starts talking about it, they'll pay attention, and they'll want in. But by then, the easy money will have been made. By then, premiums will be through the roof. By then, availability will be constrained. By then, they'll be buying at the top of the move instead of the bottom. That's why right now, right here, this moment is so critical. Because we're still in the accumulation phase. We're still in the phase where you can get positioned at reasonable prices with reasonable premiums. We're still in the phase where the smart money is buying and the dumb money is ignoring. But that window is closing. Fast. Look at what happened in March 2020. When COVID hit and everyone panicked, try buying physical gold or silver. Dealers were sold out. Premiums went to $10, $12, $15 over spot on silver. Wait times went to 6 weeks, 8 weeks, 10 weeks. You couldn't get metal at any reasonable price. The same thing is going to happen again. Except this time, it's going to be worse. Because this time, the supply situation is tighter. This time, the demand is stronger. This time, the fundamental drivers are more powerful. And here's something else to consider. The mining industry is in trouble. Gold mining costs have been rising steadily. Energy costs are up, labor costs are up, equipment costs are up, environmental regulations are tighter, permitting takes longer. It's harder and more expensive to mine gold today than it was 10 years ago, which means at current prices a lot of marginal mines aren't profitable, which means production isn't growing, which means supply is constrained. Meanwhile, demand is exploding. Central banks are buying at record levels. Institutions are allocating. Retail investors in Asia are accumulating. Industrial demand for silver is surging. The supply-demand imbalance is getting worse, not better. And the only way to resolve that imbalance is through higher prices. Much higher prices. So what should you do? What's the action step here? First, understand that this isn't about trading. This isn't about trying to time the perfect entry and exit. This is about positioning. This is about having exposure to an asset class that's going to benefit from the macro trends that are already in motion, trends that can't be stopped, trends that are mathematical certainties. Second, focus on physical metal, not paper gold, not gold stocks, not gold ETFs. Physical metal that you can hold in your hand or store in a secure vault. Because when the paper market breaks down, when the disconnect between paper and physical becomes undeniable, physical metal is what's going to hold its value. Physical metal is what's going to be in demand. Physical metal is what's going to protect your wealth. Third, act now. Don't wait for confirmation. Don't wait for prices to break out. Don't wait for the financial media to tell you it's time, because by then, it'll be too late. By then, you'll be buying at higher prices with higher premiums and longer wait times. The time to position is when nobody's paying attention. The time to position is when the smart money is accumulating quietly. The time to position is now. Because what's coming next in the metals market isn't just another bull run. It's not just another cycle. It's a fundamental repricing of monetary metals in response to the greatest monetary experiment in human history. We've printed more money in the last 3 years than in the previous century combined. We've accumulated more debt than at any point in human history. We've created more financial instability than at any point since the Great Depression. And the consequences of those actions are starting to manifest. Inflation is proving to be stickier than anyone expected. Interest rates are staying higher for longer. Debt service costs are exploding. Geopolitical tensions are escalating. The dollar's reserve status is being challenged. The entire post-World War II monetary order is being questioned. In that environment, gold and silver aren't speculations. They're necessities. They're the assets that have always preserved wealth when everything else fails. They're the assets that central banks turn to when they lose faith in each other's currencies. They're the assets that individuals turn to when they lose faith in their government's ability to maintain the value of their money. And right now, faith is eroding. Fast. You can see it in the central bank buying. You can see it in the physical premiums. You can see it in the inventory drawdowns. You can see it in the institutional allocations. The smart money is voting with their wallets. They're moving out of paper and into hard assets. They're moving out of promises and into tangible value. The question is, are you going to join them? Are you going to position yourself for what's coming? Or are you going to wait until it's obvious to everyone, until prices have already moved, until availability is constrained, until premiums are astronomical? Because I can tell you from 2 decades of watching these markets, the people who make life-changing returns aren't the ones who wait for confirmation. They're the ones who see the setup, understand the fundamentals, and act before the crowd. They're the ones who buy when it's uncomfortable, when nobody's talking about it, when the mainstream is focused elsewhere. Right now, we have that setup. We have the fundamentals. We have the technical picture. We have the institutional accumulation. We have the central bank buying. We have the supply constraints. We have the demand growth. We have every ingredient necessary for an explosive move higher. The only question is timing. And while I can't tell you the exact day or week when this breaks out, I can tell you with absolute certainty that it's coming. The math demands it. The fundamentals demand it. The market structure demands it. So if you own metal, prepare yourself. Prepare for volatility. Prepare for sharp moves. Prepare for premiums to expand. Prepare for availability to tighten. Prepare for the mainstream to suddenly discover what you already know. And most importantly, prepare to hold through the noise, through the volatility, through the inevitable pullbacks, because this move is going to be bigger and last longer than most people expect. And if you don't own metal yet, if you've been sitting on the sidelines waiting for the perfect moment, understand that the perfect moment is now. Not because prices can't go lower in the short term. They can. But because the risk-reward is so asymmetric that waiting makes no sense. The downside is limited. The upside is enormous. And the probability of a major move higher is increasing every single day. This is your moment. This is your opportunity. This is your chance to position yourself for what could be the most significant wealth transfer in modern history. From those who hold paper promises to those who hold real assets. From those who trust the system to those who prepare for its inevitable reset. From those who wait for permission to those who act on conviction. The metals market is sending you a signal right now. The question is, are you listening?